Hello and welcome to AI Market News by LM. Welcome to the deep dive. Okay, before we get into, well, a pretty wild story about $19 billion in crypto bets just evaporating last Friday, we absolutely need to cover our disclaimer first.
Right. So this video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. And remember, as this content is AI-generated, there might be errors in proper names, pronunciation, or maybe some unnatural speech. Also, very important, this video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Okay, great. So our mission today, we're trying to make sense of the global markets, really focusing on this bizarre 72-hour roller coaster. We saw huge geopolitical fears tanking the market, then this whiplash recovery in pre-market trading. The big question for us is, has the market really shaken off that fear, or is it just, pinning its hopes on the upcoming Q3 earnings?
That's the million-dollar question, isn't it?
Yeah.
And to start unpacking that, I think we have to look at investor psychology first. The Fear and Greed Index is perfect for this. It's basically a tool that helps us gauge if the U.S. stock market is fairly priced or if emotions are running the show.
Right, the classic idea. Too much fear pushes prices down too low, and, well, too much greed inflates them.
Exactly. And one component, the VIX, everyone watches the VIX, the fear gauge. It's already showing some signs of, let's say, relief. It was recently measured near 19.5. That's a drop of almost 10% in volatility.
Nearly 10% is quite a drop. So that suggests the immediate panic from last week is maybe easing off a bit.
It suggests that, yeah. But, the VIX can sometimes lag. It's not the whole picture. We also need to look at how investors are actually positioned. The index uses 7 indicators, and one I find really telling is the put-call options ratio.
Ah, okay. Explain that one.
Well, if you see the 5-day average of puts bets that the market will fall versus calls bets it will rise, climbing above 1. That means people are buying more protection, more insurance. It signals genuine fear creeping in.
Got it. And then there's also just the raw strength, right? Like how many stocks are hitting new highs versus new lows.
Precisely. The number of net new 52-week highs versus lows on the NYSE.
Yeah.
When you see way more highs than lows, that's often a sign that maybe greed is taking over.
Okay, so lots of moving parts in that index. But the volatility drop seems key right now, especially given, well, Friday.
Oh, yeah. Let's talk about Friday, October 10th. It was pretty brutal.
That threat of 100% tariffs on China just sent shockwaves, didn't it? U.S. stocks just plummeted.
Brutal is definitely the right word. The S&P 500 fell nearly 3%. Dow lost almost 2%. And the NASDAQ, which is always so sensitive to this stuff, tumbled over 3.5%. Ouch.
Wow, and I bet tech got hit hardest.
Absolutely. You saw big names like Tesla, Amazon, Nvidia, all down around 5%. It really felt like the market was pricing in a full-on trade war by the close.
But then the weekend happened, and the narrative completely flipped. We saw various news commentary reporting a shift in tone from President Trump.
A complete 180, almost. Reports came out suggesting he was praising President Xi Jinping, saying a deal would be all fine.
And the market reaction was immediate, wasn't it? Futures just surged.
Instantly. Dow futures jumped over 1%, S&P 500 futures were pointing up about 1.42%, and the NASDAQ 100 futures nearly 2% higher before Monday's open.
That's a huge reversal. It almost feels like the market expects this kind of pattern now. Is this that taco trade idea people talk about?
Yeah, that's one way to put it. It's a sort of cynical view, maybe held by some institutional players.
Explain that cynicism. Why bet on the U.S. chickening out, as they say?
Well, the thinking goes like this. Washington uses really aggressive talk, these extreme threats, mainly as a negotiating tactic, right? But when it actually comes down to it, especially before a big deadline like this November 1st one that's apparently looming, they tend to pull back from the most damaging actions.
So the market hears 100% tariffs and thinks, okay, posturing, let's wait for the walk back.
Kind of, yeah. It prices in the expectation that talks will continue, that the absolute worst-case scenario gets avoided. It's a risky bet, but it paid off this weekend.
We should also probably mention the situation with the Israel-Gaza conflict easing. It helped too, right? The peace agreement, the hostage release talk, that must have calmed nerves globally.
Oh, absolutely. Anything that reduces that overall geopolitical risk is going to help stabilize things. When that immediate risk-off feeling fades, money tends to flow back into assets like stocks.
Okay, so that connects the geopolitical picture to equities. Let's broaden out now. How did currencies react to all this? The U.S. dollar index looked pretty strong.
Yeah, the dollar index was firm, hovering near 98.9. You definitely saw that strength playing out against the euro.
Right. EURISD was trading lower, around 1.159 or so.
Correct. But the really interesting action, I think, was with the Japanese yen. It's been remarkably weak.
USD/JPY higher then.
Significantly higher, yeah, near 152.2. And what's driving this is fascinating. It's not just the usual interest rate difference between the U.S. and Japan. There's real political uncertainty in Tokyo right now, that LDP coalition collapsing.
So political instability means policy paralysis.
Pretty much. The market expects this to keep the Bank of Japan on the sidelines, making rate hikes less likely, which just hammers the yen.
Okay, so stocks rallied hard on the trade news turnaround. Did the bond market buy it, or were bond traders still hiding?
Well, they definitely ran for cover on Friday, no question. The Treasury market saw a sharp rally, typical safe haven move. The 10-year yield is around 4.069%. But as that risk aversion eased over the weekend, we started seeing some of those gains get trimmed back. Money moving out of safety back towards risk.
Makes sense. Now, commodities and crypto, they saw some pretty extreme moves, but kind of in opposite directions. Gold first, new record highs. That's huge.
Yeah, gold surged past $4,090 an ounce.
Yeah.
That's really significant. This isn't just a temporary safe haven bid because of, a geopolitical flare-up. Hitting a fresh record like this suggests some traders are pricing in deeper, longer-term worries about currency devaluation, regardless of the latest trade headlines.
Interesting contrast. Meanwhile, oil seemed happy about the trade news.
Yeah, crude oil WTI was up almost 2%, hitting $60. That makes sense. Eased trade tensions usually mean better outlook for global growth, which means more demand for oil. Pretty straightforward.
Okay, and then Bitcoin. What happened there after Friday's scare? You mentioned a massive liquidation.
Massive is the word. Friday saw a record 19 billion with a B, and leveraged crypto bets just wiped out. A huge flush out.
Wow, $19 billion. Did the price collapse?
It took a hit for sure, but it actually stabilized pretty quickly over the weekend. It's been hovering around the $115,000 mark.
So the froth got blown off, maybe, but there's still underlying support there.
That seems to be the interpretation. The excessive leverage is gone, but demand seems solid around that, psychological $115 level.
Okay, let's shift to the macro view looking ahead. What are the big things on the radar? We know the Fed rate is 4.25%, ECB at 2.15%. The next Fed meeting is October 29th.
Right, and all eyes are on that FOMC meeting. We look at the CME Fed Watch tool for probabilities, and the main question is still, will the Fed keep focusing on, say, economic stability, even if inflation is a concern? Does that mean more rate cuts could be on the table down the line? That uncertainty is partly why the dollar is strong, but it also means the market's focus might shift.
Shift away from central banks and towards earnings.
Exactly. But first, let's quickly check the economic calendar. Investing.com shows today, Monday the 13th, is actually a holiday in the U.S., so things are quieter stateside.
But not globally, right? There's still stuff happening.
For sure. We're watching things like the German WPI data for Europe. And even with the U.S. holiday, there's still some data releases scheduled. We've got U.S. construction spending for August at 7:00 a.m. Eastern, and wholesale trade sales, also for August, at 10:00 a.m. Eastern. Plus, the OPEC monthly report is out, always important for oil prices.
Okay, but the really big event kicking off this week is Q3 earnings season.
This is it, crunch time. After all the noise about tariffs and geopolitics and VIX spikes, now we get back to basics. How are companies actually doing?
And this is where that question about the AI trade comes in, right? Can the hype survive the reality of the numbers?
That's the core test, absolutely. It starts this week with the big banks, Goldman Sachs, JP Morgan, Citi, they report starting Tuesday. Then later in the week, a key one for tech watchers, the chip equipment maker ASML.
So these reports will really tell us if this recent market rally has legs, if it's based on solid ground, or if it was just relief about trade talks.
Exactly. And, just a final thought to leave folks with, it strikes me as interesting. You've got gold hitting all-time highs, potentially signaling deep worries about currency value long term. But at the same time, you have tech stocks, especially AI-related ones, surging on what seems like pure optimism.
Yeah, those seem like conflicting signals.
Right. How long can those two very different stories exist side by side in the market? It feels like something's got to give eventually. That's what we'll be watching.
It's a great point to ponder. Okay, that's all the time we have for this deep dive. Thanks for watching. Don't forget to like and subscribe.